You know, you always hear traders talk about the dreaded margin call. It sounds terrifying, right? But what does it actually look like when it happens in real life? Well, we're going to break down a trading scenario that went horribly wrong just to show you the real anatomy of a margin call. So, yeah, that's the million-dollar question. What really goes down? I'll tell you this much. It's not some friendly phone call from your broker asking you to top up your account. Oh, no. It's an automated, frankly brutal process that's designed to protect them, not you. So let's walk through it step by step, pip by pip, and see just how fast an account can completely unravel. Okay, so first things first. Every broker plays by slightly different rules. But for our story today, the rule is simple and totally unforgiving. The margin call level is set at 100%. What that means is if the account's health, which we call the margin level, drops to this point, the alarm bells don't just ring. The system literally takes over. All right, let's set the stage. Every story has a beginning. And for our trader, things are looking pretty good. They've funded their account, they're feeling confident, and they are ready to put on a trade. Our trader is starting out with a balance of $1,000. You know, a pretty common starting point for a lot of folks dipping their toes into the markets. Right now, it's all just pure potential. So after doing their homework, they decide to go long on the Euro/USD pair. They're buying one mini lot, which means they're essentially betting that the euro is about to get stronger against the US dollar. Now, to even open this trade, the broker needs a little something up front, a good faith deposit. This is called the required margin. Honestly, the easiest way to think about it is like a security deposit when you rent an apartment. It's not a fee you're paying, it's just collateral that the broker holds onto while your trade is open. So how much are we talking for that deposit? Well, based on the size of the trade and the broker's 2% margin rule, the math works out to $230. So that amount is now kind of fenced off from the rest of the account to act as collateral. And we're live. The trade is on. At this very moment, everything is looking fantastic. The position is sitting at break even. And more importantly, look at that margin level. A super healthy, super comfortable 435%. It feels like you've got this massive cushion. I mean, what could possibly go wrong? Well, as anyone who's ever traded knows, the market has a mind of its own. And this, my friends, is where our story takes its first dark turn. The trade starts to move, all right, but in exactly the wrong direction. And then, bam, a sudden, sharp move. EUR/USD absolutely plummets 500 pips. For our trader, who bet on the price going up, this is a huge and incredibly fast paper loss. That confidence from just a few moments ago, yeah, it's starting to evaporate. You can just imagine that horrible sinking feeling in the pit of your stomach, can't you? All that initial excitement is just gone, replaced by this cold knot of anxiety as you watch the red numbers get bigger. So let's check the damage report. That 500 pip drop translates into a $500 floating loss. Half the account's initial balance is just gone, at least on paper. And that all-important margin level, it's been slashed nearly in half, all the way down to 227%. I mean, it's still technically safe, but the danger is suddenly very, very real. Our traders just holding on, hoping, praying for a reversal. But the market can be absolutely relentless. This situation is about to go from just being bad to being critical. The account is getting dangerously close to its breaking point. And there it is, another brutal drop, this time 288 pips. This isn't just a little dip anymore. This is a catastrophic move against our trader's position. A quick look at the dashboard shows the full extent of the damage. The floating loss has now ballooned to $788. The account's real-time value, its equity, is down to a measly $212. But here's the killer number, the margin level. It now reads 99%. They've done it. They've breached the 100% threshold. The line in the sand has been crossed. And that's it. That's the moment. The trigger is pulled. The broker system immediately flags the account. This is the margin call. There's no warning, no nice phone call, just an automated execution. So, what happens now? This is the part that so many traders just don't fully grasp until it's way too late. The system takes control now. Its only job is to stop the bleeding and protect the broker. Welcome to the automatic liquidation. It's a three-step process, and believe me, it happens in the blink of an eye. First, the platform just automatically closes that losing trade at whatever the current market price is, no questions asked. Second, that used margin, the $230 collateral, is released back into the account. And third, and this is the most painful part, that massive $788 floating loss is no longer just on paper. It is now a permanent, realized, irreversible loss. And here's what's left after the dust settles. The trade is gone. The screen is flat. The final account equity stands at just $212. That's it. That's all that's left from the original 1,000. I mean, this before and after table really says it all, doesn't it? Our traders started with a hopeful $1,000. After one bad trade, the final balance is just $212. The damage is just stark. To put a final number on it, in one single trade, our trader lost 79% of their capital. Gone. Just a devastating blow, and one that frankly could have been avoided with better risk management. So, what's the big takeaway from this financial horror story? Well, it's a very painful but also a very, very clear lesson about how leverage and risk really work in the real world.
Look, if you remember one thing from this, let it be this. Your margin level is the most important number to watch when you have a trade open. It's not just some random statistic. It's your account's real-time health meter. Ignoring it is like ignoring the flashing oil pressure light in your car. Sooner or later, the result is going to be catastrophic engine failure.
You know, the warning from our source material is pretty graphic, but it's also profoundly true. Truly understanding how quickly your positions can be automatically closed out, yeah, it's a gut-wrenching lesson. And that really just leaves us with one final question to think about. How will you be watching your account's health meter on your next trade?